In this video, we are going to talk about the essentials of gold trading and how you can build your own gold trading strategies. But with a bit of history to better understand gold. Gold is an extremely valuable resource that has been traded and used as a currency for centuries, and there is data that shows how much it cost in 30 BC. Gold is still seen as a safe investment, and there are many different strategies that traders use to capitalize on the market. Whether you're a new trader or an experienced investor, it's important to understand the basics of gold trading strategy before you begin to invest. Let's discuss some of the most popular strategies used in gold trading. There are several ways to trade gold, but only a few are actually works. Gold is a highly liquid trading product, which means it is easy to trade. It can be exchanged at any trading centers, and most transactions are done over the counter. Gold prices can be volatile, but there are always enough buyers and sellers in the market. Traders and even governments can place large trades with little market impact on the international gold market. But there are some factors that affect the price of gold. For example, because of changes in international politics, when hostilities rise, gold price tends to climb. Because these political and economical events push the investors to buy or sell gold. Conflicts, elections, and pandemics almost always push investors to do something with their gold for one reason or another. Gold and the US dollar have an inverse connection due to differences in monetary policy. Therefore, the dollar will strengthen and gold will be under pressure as a result of anticipation of higher interest rates in the US. Also, gold tends to rise in price when investors are fearful about rising inflation, as the allure of having cash dwindles. However, if investors forecast lower as interest rates in the future, the value of the US dollar may fall while gold's price would rise. As gold is denominated in dollars, any rise or drop in the US dollar is usually immediately reflected in the price of gold. Gold prices tend to increase when the dollar is falling. That is because in relative terms gold becomes more expensive, and vice versa, gold tends to decrease in value when the dollar is rising because the price of gold effectively becomes cheaper in dollar terms. Typically, when the interest rates go down and prices of gold dropping if interest rise. Real interest rates are calculated by subtracting the inflation rate from the nominal interest rate. This way you get a percentage that is adjusted for inflation. Historically, the gold prices have gone down when the real interest rate is below 1%. So by watching the interest rates, for example, that the Federal Reserve and other central banks across the world, you can find potential buying and selling opportunities, particularly if you are trading longer-term positions. Central banks are some of the largest players on the global gold market, as they buy and sell the precious metals to add or take away from their reserves. When central banks start buying more gold, that can cause the price to increase, at least in the short term. And if gold prices then subsequently form an uptrend, that could be an opportunity worth following. Another thing is gold production and how the stocks of various gold mining companies perform. The remaining gold in the earth is limited and also expensive to extract, but increasing demand and rising price might provide more investment to mining companies. So, by looking at the stocks of gold mining companies, we get an idea of how much gold is being mined and added into the system,